Now, there are two key factors for this trading strategy. They're so simple, it might shock you. Trade Pros, Victor from TRADEPRO Academy, and today we've got another video for you. I'm going to be talking to you guys about a new day trading strategy that's good for beginners. We're going to be talking about a day trading future strategy that beginners could find a little more useful and a little easier to use. So in front of me, we've got a 4-tick 1-range chart. And we use these range charts quite often. But before we dive into this, guys, if you guys want to know more about this stuff, more about what you see on the screen, more about order flow, check out the link down below. We've got a free order flow trading course and another different free trading course that TPA actually offers. So before we get started with this video, go down into that link and check it out. But before we start this video, if you guys, again, would like to drop a like and hit that subscribe button so you don't miss out on any future incoming videos. So as we come into this day trading strategy, we have just experienced a surprise cut by the Fed, so a 50 basis point cut, which brings about a lot of volatility. Now, this day trading strategy for beginners is especially good in these volatile market environments because it presents you with an opportunity almost off the open to get into a lot of these moves and potentially hold the trade out for a long time. So if you guys guessed that these lines here on the chart have something to do with this blue line and this blue line, you were totally correct. So we're going to be using what is an opening range here for our trading strategy. That is it, plain and simple, the opening range strategy, especially for beginners. It is a very easy strategy to learn and to use and to get used to at that. So the opening range starts at the US Open. So at 9:30 a.m. Eastern, we get that open and the opening range begins to form. What the opening range is, it prints both the high and the low for a certain time period, and it extends those lines horizontally throughout the rest of the chart. Now, there are two key factors for this trading strategy. They're so simple, it might shock you. Number one, break above the opening range high, you're getting long. Number two, a break below the opening range low, you're getting short. There's a little more to it, but those are the stone basics of this strategy. Very, very simple. Now, what is the opening range? Again, we explained it a little, but in more detail, printing the high and the low of a certain time period. This specific opening range here is for the first 30 seconds. Why for the first 30 seconds? Well, usually in the pits back in the day when they traded in the floor, those Wall Street movies that you usually see, or those different movies where you see a bunch of guys just yelling, throwing tickets at each other. Back in those pits, they generally use the first 30 seconds as their opening range. And a lot of traders above, they'd get long, below, they'd get short and ride those as long as they could. Now, that's why I generally use a 30 seconds, especially in volatile markets like today. It'll be a wide 30 seconds. So in this case today, from the 95 all the way down into about the 85, so a 10-point opening range gives you a lot of opportunity for a break above or below. That's a pretty wide range. A lot of people in slower market conditions use anywhere between a 1 minute to a 5 minute. But in these current market conditions, try that 30-second opening range, bump it up to a 5 minute if markets start slowing down. Now, right here in this example, it's very, very simple. Once you start to see the opening range low actually break out, as price starts going towards that opening range low, you start to see it break out. Your initial trade is the retrace off that broken opening range low. Now, a key trick and tip here is if you're trading the S&P 500 like you see here on my screen, anything 3 points or less is considered noise. So let a break of a level happen of at least 4 points or more to capture that convincing move of a breakdown to the downside or upside. Now, we do get a 4-point break here to the downside and we retrace. That's your opportunity for a short. From the 85s, you're riding them down to wherever it brings you. In this case, about the 79s, 80s. So that's a solid profit right there. 5 points on the S&P, one contract. That's $250 US, considering $50 per point. Now, there's more to the strategy naturally as it retests back into it. You're waiting to see maybe some rotations and consolidations if you are going to continue looking for shorts. Or we could just rally back up like it did within this opening range. Then it breaks below, retraces, then you get another short opportunity. Again, here you retrace it, you get a few rotations, and then you get another short opportunity. So this is what you're doing. And if you guys potentially miss this opening range trade, whether it's to the downside or the upside, what you need to know, especially for you beginners, below that opening range, you could be looking for continuous shorts. That's what the market structure is telling you. You identify your broken levels and you look for the retraces for the short idea. Very simple. Below the opening range, looking for shorts. Above the opening range, looking for longs. So if we look at it to the other side and we pop above that opening range, we could see a retrace or two for the continued move to the upside. Now, risk management is very important in this strategy, but it's very, very simple. So let's see if we can find another day that has the opening range strategy laid out, if my Sierra has loaded that data here. So here's another example of an opening range on yesterday, the beginning of March, first trading day of March right here. Let us open this guy up right into the open of the trading session. So this is where the open of the trading session occurs. We get a slight little pop off that 30-second opening range, as you guys can see, and we don't really get a retrace. It's just a breakout pop, little head fake. But here you're getting a few chances. See, you head fake to the downside, head fake. You get a few chances, maybe look for some longs on the retrace of some of these opening ranges as they break to the upside with a convincing few amount of points. Now, at this point, you want to see rotation, so maybe this isn't too confirmed. But right here to the downside, you get a break and rotation. You can find a lot more short opportunities than maybe longs, right? You might have tried the long here on the opening range breakout to the upside. Like I said, above the opening range high, you're getting long, and you could add some profitability based on your risk management. Right here is a pretty good example. Looking for the retrace into that broken opening range high, you're catching some longs, right? This strategy requires a lot of practice like any other strategy, but it's a very, very simple strategy for beginners. Long above a certain level, short below a certain level. What this does, it mitigates the need to look for all these different trade opportunities and that confusion of where am I long, where am I short. It also limits the number of trades you do a day, which is a good thing because that decreases the potential of over trading, which is a bad habit that a lot of new traders learn. And finally, it gives a really strong, profitable potential. If you catch a good opening range breakout trade or pullback trade into the broken opening range, you can ride it even for days as long as the trend continues, right? Different stop trailing strategies should be implemented in this, but you can catch amazing moves. So those are the three main things that are amazing about this opening range strategy. Sometimes it doesn't really work. You can see right here, first few tries, you may have failed, but ultimately you have to give yourself a certain amount of tries that you're looking for a day and certain confirmations, right? So maybe some of the confirmations didn't get met, so you weren't really trying these, right? If you want to see maybe some rotations after it breaks on the retrace, then you actually get the longer short. That increases the profitability and probability of this strategy. So I hope you guys enjoyed this very simple day trading strategy for beginners, broken down pretty easily for you guys to understand. This is a study on Sierra that you can add. You could add this on any other platform as well. You're just looking for extended horizontal line that is based on the first 30 seconds or 5 minutes of the open, the highs and the lows, and you're looking for breaks below and above to get longer or short. Now, again, if you guys enjoyed what you guys saw on the screen and you want to learn a little more, just check those links down in the description. We've got a great order flow trading video series for you, free lessons to understand how order flow works. So take a peek inside the candle with order flow, understand how the market actually moves. If you guys want to see more about market structure, just comment down below what you guys want to see, in terms of strategies, and maybe we'll make a video on one of these comments that you guys have put down in the description. So again, this was Victor from TRADEPRO Academy. If you guys like this video, smash that like button and hit that subscribe button for more great videos like this. And we'll see you guys next time. Take care.